Some insurance denials did not just cost people money, they cost them their lives. Behind closed doors, paperwork became a death sentence. But one case exposed something even more disturbing. The denial may have been the plan. Number 11. Salim Sandy Corcoran versus Blue Cross of Louisiana. After the denial, Corcoran did what most patients cannot. He treated the file as evidence. Salim Sandy Corcoran was a Louisiana attorney with stage 4 throat cancer. His doctor recommended proton therapy, a targeted treatment that could spare healthy tissue. Blue Cross and Blue Shield of Louisiana refused to cover it, calling it not medically necessary and outside its policy. The review went through AIM Specialty Health, later renamed Carelon Medical Benefits Management. ProPublica's February 15, 2024 investigation reported that outside reviewers did little meaningful checking with outside sources before upholding denials. The doctor's recommendation became policy language. Corcoran paid for the treatment himself, then sued. That is the price of a denial when the patient can afford to fight. Next, the dispute turns on whether the insurance was even there at all. Number 10. Patsy Bates' HealthNet rescission. Patsy Bates was on a surgical prep table when HealthNet told her the policy no longer existed. She was a Gardena, California hairdresser, insured by HealthNet Life Insurance Company since August 1, 2003. In September, doctors diagnosed breast cancer. By January 2004, while she was still in active treatment, HealthNet rescinded the coverage retroactively. That left at least $129,809 in unpaid medical bills. The mechanism was post-claim underwriting. Once treatment became expensive, HealthNet reviewed her application for reasons to cancel coverage, and internal documents later showed employees could receive bonuses tied to rescissions. In 2008, an arbitrator awarded about $9 million, including $750,000 for emotional distress and $8.4 million in punitive damages. Number 9. Prudential evidence of insurability death benefit denials. After that courtroom verdict, you are now in a quieter room, where a family opens a life insurance claim after a funeral and finds the dispute waiting in the paperwork. This was Prudential Insurance Company of America's evidence of insurability issue in employer-sponsored life insurance, addressed in a United States Department of Labor settlement announced on April 19, 2023. The department said Prudential had denied death benefit claims by arguing there was no evidence of insurability, even after collecting premiums from workers. Under the settlement, if Prudential collected premiums for more than 3 months, it could no longer reject a beneficiary's claim on that basis. The harm here is colder than a hospital denial, because the patient is already gone, and the family is left proving a promise existed. Next, the denial moves back into the clinic, while the clock is still running. Number 8. Emily Dwyer, United Healthcare anorexia denial. Emily Dwyer arrived for treatment wearing her 8-year-old sister's jeans. She was 15, severely anorexic, and her family was asking United Healthcare to cover residential eating disorder care. ProPublica reported the case in its December 15, 2023 investigation. United Healthcare denied coverage, so the choice moved from a medical review file to the family kitchen table. When the denial holds, you refinance the house or you do not get the treatment. Emily's parents refinanced their home and paid themselves. ProPublica placed her case inside a wider pattern involving United Healthcare and Cigna, where coverage decisions could be made by reviewing doctors with prior malpractice histories. This was not a confirmed death case. It was a warning about power. The insurer could say no, and the family absorbed the cost of survival. Number 7. Forrest Van Patten, Priority Health CART denial. A word ended Forrest Van Patten's appeal: gene therapy. He was 50, from Michigan, and in July 2019, he was diagnosed with aggressive lymphoma. His doctors wanted CAR-T therapy, specifically Kymriah, a treatment that engineers a patient's immune cells to attack cancer. They saw it as his last chance. Priority Health refused to cover it. The company said CAR-T was gene therapy, not a cancer drug, so Michigan's cancer drug coverage mandate did not apply. ProPublica later reported internal emails where executives discussed a, quote, defensible path not to pay. That is the corporate logic you are watching. Not whether treatment might work, but whether a label can make payment disappear. Van Patten did not survive after the denial. Michigan regulators later clarified that state-regulated insurers must cover clinically proven cancer treatments. The label did not hold. The denial had already done its work. Number 6. Nalene Fox versus HealthNet. The verdict came after Nalene Fox was already dead. In December 1993, a Riverside County jury ordered HealthNet to pay her family $89.1 million, including $77 million in punitive damages. Fox was 40, from Temecula, California, with advanced breast cancer. In June 1992, her doctors sought high-dose chemotherapy with an autologous bone marrow transplant. HealthNet refused coverage and called it experimental, so her family raised $150,000, and Fox received the transplant that August. She died in April 1993, before the legal fight ended. You are watching a family pay for the treatment first, then ask a jury what the denial really was. The jury did not just reject HealthNet's logic, it called it bad faith and priced that finding in the tens of millions. Number 5. David Goodrich versus Aetna. You are watching a coverage decision become a clock, because Aetna could wait, and David Goodrich could not. Goodrich, a cancer patient in Yucaipa, California, spent 2.5 years fighting Aetna US Healthcare of California for cryoablation, a treatment it kept labeling experimental. PrimeCare, Aetna's utilization reviewer, kept the denial moving. The denial arrived November 18, 1992. Goodrich was already dead. A PrimeCare utilization review nurse sent it on Aetna's behalf. Teresa Goodrich sued, and in January 1999, a San Bernardino jury found malice, oppression, and fraud, awarding $4.5 million in compensatory damages and $116 million in punitive damages. That was the cost of letting paperwork outrun care. Number 4. Nataline Sarkissian, Cigna liver transplant denial. Nataline Sarkissian was 17, from Glendale, California, and in December 2007, she was in Mattel Children's Hospital at UCLA after leukemia treatment and a bone marrow transplant. Then, her liver failed. Her UCLA doctors recommended a liver transplant. Cigna Healthcare denied coverage, calling it experimental, investigational, and unproven. You are watching a medical judgment become a coverage category. Her parents, Hilda and Krikor Sarkissian, protested outside Cigna's office with nurses, demanding the company authorize the transplant. On December 20th, 2007, Cigna reversed itself. The approval came hours before Nataline died that same day, at about 6 in the evening. Her parents sued for wrongful death. Cigna denied wrongdoing. The case was dismissed, largely because ERISA, a federal benefits law, preempted state claims. The system did not break. It held. Number 3. Rodney Clay Kaiser transplant transfer death. Rodney Clay had been waiting for a kidney through UCSF Medical Center since 2000. He was a Northern California Kaiser patient, and his family alleged he was near the top of UCSF's transplant list when Kaiser Foundation Health Plan, Kaiser Permanente, opened its own kidney transplant center and moved members off UC lists into Kaiser's new program. That transfer mattered. A transplant list is not a customer queue you can reshuffle without consequence. Clay's family alleged Kaiser delayed his transplant repeatedly, then sent him back toward UCSF after years already spent waiting. Before Kaiser completed the paperwork to return him, Rodney Clay died of chronic renal failure. His family sued for wrongful death, negligence, fraud, negligent misrepresentation, emotional distress, unfair business practices, and bad faith. The allegation was simple. Kaiser chose its program first, and Clay ran out of time. Number 2. Kaiser San Francisco Kidney Transplant Program Scandal. Now you see denial at system scale. Kaiser opened its own kidney transplant center in San Francisco. Then, in 2004, told more than 1,500 kidney patients it would no longer pay for outside transplant care. They were told to transfer into Kaiser's program. In 2005, Kaiser performed 56 kidney transplants. An LA Times analysis, cited by California Healthline, said about twice as many people on the waiting list died. The program shut down in May 2006. State officials later found 90 dead patients still on the national waiting list. Kaiser said the transfers did not hurt patients' chances, and that no patient was disadvantaged. Rodney Clay died of chronic renal failure before Kaiser completed paperwork sending him back to UCSF. That is how administration becomes triage. Number 1. Industry-wide $7.5 billion life insurance non-payment scandal. You are seeing the same death data used two ways, and only one of them helped families. In 2016, CBS 60 Minutes reported that 25 major United States life insurers used Social Security death records to stop annuity payments when customers died, but did not use the same records to find deceased policyholders and pay beneficiaries. Multi-state settlements later forced more than $7.5 billion in back death benefits to be paid out. In 2023, Prudential reached a separate settlement after the Department of Labor said it had allegedly denied claims for lack of evidence of insurability even after premiums were collected. Insurers knew when death saved them money and looked away when death meant money was owed to a family.